Hi there. Thanks for tuning in. Today, I'll be doing an analysis and valuation of Atkore Inc. Atkore is basically a company, let's start talking about it, who has products all around you. Essentially, they're an electricity and safety equipment company. So they will provide PVC pipes, they'll provide armored cables, wire basket cables, steel conduits, much more things that you would see in any sort of industrial or commercial facility, even some residential facilities. Here they give you an office building that manufactures some things, probably based on the bottom floor here. So you'll see that they give a ton of stuff in both security solutions, like this perimeter security solutions, like the barbed wire, or just electricity, metal framings, etc. So Atkore does a lot of stuff, sort of not in the public eye, right? They're mostly a business to business company. Consumers may sometimes buy something like a PVC pipe, but it's pretty rare. So, yeah, they're a company that does important stuff, but maybe it's a little more subtle. Maybe you don't realize that they are all around you, right? Now, they recently reported quarter 3 2023 results. And what you see, and this is opposed to the same quarter in previous years, right? All the way from 2019 all the way to 2023, there has been an increase in sales, in net income, in EBITDA, right? In earnings per share, even, although I don't like looking at that. But yeah, so relative to even last year when there was a lot of consumption, a lot more consumption, and a lot of uncertainty in the economy, they seem to be doing decent. Net sales are up 2.6%, net income is up 15.6%, EBITDA is down a little bit. So yeah, no overall, not terrible results, right? And they do have some things that affect them, like for example, the Inflation Reduction Act, which may create a larger than expected tax benefit and whatnot. So they are benefited from some trends in the economy overall. And if there is going to be an acceleration towards electrification in the world, well, they sell a lot of electric equipment, so they actually may benefit from this. They also give a nice cash flow summary in their investor presentation, which I think is great. Their cash flow from operating activities has gone up significantly. And here you'll see that from their cash flow from operating activities added to their previous year's cash balance minus capital expenditures, minus mergers and acquisitions, minus stock repurchases, which is a huge chunk of their expenditures, they end up with a cash balance that is slightly lower than the year before. However, they seem to be applying a lot of that towards growth, right? Towards expending in keeping the lights on, keeping things running. Then in mergers and acquisitions, which they've done 7 since 2017, so they clearly seek to grow that way. And then a lot in stock repurchases, which does increase the value of each of your individual stocks that you as an owner have, right? So their capital deployment framework is essentially what we were talking about. Capital expenditures, which also includes organic growth and capacity investments. So they will be investing in an HDPE product expansion initiative. So that will be, it's good that they have some organic growth and also some mergers and acquisitions. So have both kinds of growth, right? Expect future capital spending to be between 3 to 4% of net sales. So that makes it a little easier to predict as well, right? They also have a pipeline for mergers and acquisitions. They've acquired a lot of stuff. So that is going to happen. That is going to keep going, right? They also say target cash flow from operating activities is to be approximately 100% of net income, right? So they want to bring all of net income, and after a few adjustments, that will still be cash flow, right? So that's important. And also, they have stock repurchases, a bunch of stock repurchases. It's crazy, actually, how much they repurchase. So they clearly want to keep growing value and give some back to the shareholder while they're at it. Now, here is an overview of their latest 10K, which includes some information on how they've grown since 2020. So clearly, their net sales has grown, their gross profit has grown, their operating income has grown, their net income has grown. The margins are there. The margins are stable, maybe expanding a little bit, but this is something that is important to watch, right? With here, we know the net sales are going to grow because of electrification, right? So I would implore you, as you analyze this company, to not put that much attention into revenue, but put more attention into gross profit and operating income, because that's going to show what their input costs are, right? And those margins. Are those margins getting better or worse? What are their costs like, right? So that will tell you at the end of the day how much more efficient the company is getting as they benefit from these electrification trends, right? Right now, the picture seems okay, but as the future keeps going, we will see, right? Now, I'm going to go to Yahoo Finance, grab a revenue estimate, right? Which is 3.56 billion. I'm going to grab the low estimate here of these five analysts that have given revenue estimates for the company. You'll see that the range is actually really small in these revenue estimates. It's a little larger for 2024, but in 2023, it's between 3.56 billion and 3.58 billion. So it's really, really small, which I think is a good thing. And now I can do this with a discounted cash flow model. What I'm going to say here is that 16% of their revenue turns to free cash flow, which is in line with last year and is a little bit lower than in 2022, or sorry, in 2021. And then I'm just going to say, okay, these two estimates for 2023 and 2024 will be true, the low estimates to be conservative. And then after that, I'm going to grow by 1% in 2025 and 2026, and then 2% in perpetuity, right? I'm going to be very conservative with this company. I'm going to say they're going to have maybe a little bit of a tough year this year and the coming year, and then they're slowly going to wind up and then grow at 2%, right? Then I'm going to have a required rate of return of 11%. That's 1% more per year than the market on average, which over time adds up to be a lot. I'm going to divide it by the total number of shares, and I get a fair value of 161.82 US dollars. However, subtracting the net debt they have, which is $540 million, I get a fair value of $147.53 per share, and that's with net debt included. Now, where's Atkore right now? That's very interesting. So Atkore, if you'll see, this is the 5-year overview, and Atkore has had huge growth since its IPO, right? But even then, it seems to be undervalued right now. And it's not a huge company. It is not even $5 billion company. It's trading at a PE ratio of less than 7, which is a very low number in relative terms. So right now, based on my model and my very conservative growth assumptions, it seems to be at a really good price, right? Let's look at another measure of value, which is EV to EBITDA. Now, Atkore seems to be, their trailing EV to EBITDA is 3.8 times. Their forward is 4.2 times. Here are a few potential competitors. You have a few that may be a little lower. Really, it's just one or two, Encore Wire Group and then Asia Pacific Wire and Cable Corporation. But compared to the industry, where the industry median is 8.2 times and 7.4 times, this 3.8 and 4.2 is a lot lower. So that could show an undervaluation relative to its peers at the very least. So let's talk a little bit about this company that's looking a little interesting. Atkore is a boring company that provides a cheap valuation with conservative growth estimates according to what I calculated. Slowing construction and normalizations in price will still affect margins in the future, but the company is potentially well poised to take that hit. That is to say, PVC pipes, for example, PVC and a few other things in the electricity sector have benefited from higher inflation, and Atkore actually benefits from that. They manufacture that. They can sell that on the expensive. Price will normalize a little bit, right? So basically their costs are going to, or their revenues may take a little bit of a hit there. And if construction slows down, the revenues will also take a little bit of a hit there. But I put in some really low growth estimates, and they still seem to do okay in terms of valuation, right? So they seem to be poised to take that hit. They don't have a ton of net debt, at least not relative to their net income, for example, or their EBITDA. And goodwill is growing, but not at a worrying level. When a company makes a lot of acquisitions, you should watch the goodwill. So they have 300 million in goodwill, as opposed to triple that for net income, or 318 million in cash. And there's a clear emphasis in growth and share repurchases. So that's cool because you know at least they're giving back some money to the shareholder. So it seems that they have revenue growth, they have EBITDA and free cash flow growth, they have share repurchases. Okay. And it can potentially be well priced if you agree with my estimations. So what I'll say is that investing should be boring. And a very boring company like this one, Atkore, which essentially just does electricity, industrial safety equipment stuff, they can be some of the better companies out there. They can be some of the more interesting opportunities here. It doesn't always have to be an exciting company that you see every day, but some companies like these can be very interesting, and investing can be very boring. You can just buy and hold a company that is boring like this and just have it generate returns in excess of what the market would do for many, many years and decades. So, with that said, I hope you found this analysis useful. Thank you very much for watching. Please don't forget to like, subscribe, and comment. It really helps me out a lot with the YouTube algorithm. And with that said, I hope you have an amazing rest of your day.